Hey everyone, welcome back to part 2 of my HireQuest analysis. Now today we're going to look at some of the concerns first, and I think that's really important. So we'll eventually get to evaluation by the end of this analysis, but we've got to cover a few things first. So I'm going to jump into that. Before I do, Interactive Brokers is the broker that I use personally. If you're looking for a broker, I think they're the most reputable in the world. Link in the description for that. Okay. Let's jump into some of the potential issues with this investment in HireQuest. So if you haven't watched the previous video, I sort of summarized how it works and a high level view and a bit of a pitch in why I think this is an interesting business. Let's look at the flip side of that. So people have noticed that wages are rising. So maybe people are less inclined to hire daily staff people because it's maybe potentially getting more expensive. But then again, it doesn't really affect the margins of HireQuest because their prices, they just get passed on to the customer. So they have pricing power there. So there's no real issues from an inflationary point of view here for HireQuest. The issue will be is that if it gets into tough economic times and people start getting generally the economy is not spending as much money and people start maybe events get delayed or put on hold or just a general decrease in overall spending in a tighter economic environment. This will affect HireQuest. There is no doubt about it. It'll affect nearly everybody in every industry though, as spending rates go down. But on the flip side of that is that if a lot of people getting laid off from their jobs, they're going to start to look for alternatives, especially alternatives while they're searching for a job as well. And daily labor hire is actually an ideal place for them to get a little bit of work coming through to keep paying off their mortgage if they need. There is a bit of a flip side that more people might actually be coming to HireQuest, but the problem might then be that HireQuest might not have enough work for all those people. So a downturn in the economy is not great for HireQuest, and that would be a concern. And then there's, I guess, an opportunity for HireQuest as well, that there's thousands of these staffing companies throughout America and throughout the world, like thousands and thousands and thousands of small little mom and pop operations, and they could have debt issues. There'll be plenty of them that leave it up and had to borrow a lot of money to get started in that business. So if a recession was to hit, some of those might become a bit more flimsy and a little bit more available for an acquisition, let's say from HireQuest, who are sitting in a really good financial situation. Opportunities might actually present themselves in really interesting geographic areas that they think are really easy, good places to expand into. The tough times are going to be difficult on the business, but if they can be strong and weather through it, opportunities could arise as well. So there's two sides to that coin. But as a reminder, HireQuest were profitable back in Q2 2020, which is probably as tough of a test as you're going to get in the depths of the pandemic and the lockdowns in America. So the fact that they were still profitable shows a lot that this is a durable business and they're going to weather the storm better than most. Now, regarding acquisitions that they've done in the past, let's look at a recent deal. They just made an investment in a company called MRI. They paid about 4 times EBITDA for it, but it's a lower margin business. It's still a good deal. That's going to be about a 20 to 30% return on invested capital in a new area for them to grow and diversify their revenues. It's in the more professional services daily staffing business. But even if it is lower margin, it isn't actually that low. It's probably like 35% EBITDA margins, which compared to around 60% EBITDA margins for the rest of the businesses it does seem low, 35 compared to 60%, but 35% is still quite strong. And they're only paying 3.5, 4x for it. So I think that was a pretty good deal, and it shows that they're savvy and that the deals that they have on the table they're not overly expensive or overly competitive, which is good. Now, regarding management, there's a really good video here on YouTube by Mindset Capital. That's Aaron Idlehart, who, sorry about if I'm mispronouncing your last name, but he interviewed Rick Hermanns, the CEO, and that was a great interview to get a feel for how Rick thinks. I want to interview him myself as well here on the channel, so stay tuned for that. But Rick, as the CEO, he owns 43% of the stock. Insiders as a whole own around about 60% of the stock, so that doesn't leave a whole lot left. That shows fully incentivized management, which is good. I like that that Rick has this vision to see that the best way to run this business in this industry is through the franchise model. It works. They've tested it. They're up over 300 franchise locations at the moment, and it's expansion time now. Which is really cool to see. Rick himself has 30 years experience in the field. He knows the industry inside and out. The track record that is there, and it's really solid. I'm feeling good about management. So this is HireQuest's most recent presentation, and you can see that they've got over 300 franchises in 400 plus locations. That's the diversification of this already. So there's a track record here. It's not some sort of startup that only has 3 or 4 locations. 300 locations gives them diversified revenue, which is good. I think that's strong, stable revenue. If we look at the different sectors that they're in, they have like just normal like labor solutions. Then they have like executive and professional solutions as well. And there's definitely some expansion horizontally going on here as well throughout the different niches inside the servicing sector. So this is really good to see. They've got a lot more. There's just so much room to grow here. There's so many in just the general labor hire, let alone all the other little niches as well. So this business has a long runway to go. And speaking of that runway, if you have a look here at this map, we can see that Texas has about 50 offices and Florida has about 50 as well. But some of the states only have 1 or 2, and there's huge amounts of room just to grow here in America. Like imagine all the cities that are say over 150,000 people. There must be thousands of them throughout America, and yeah, you could have one of these offices in every one of those cities, and even just like almost every suburb of New York and the big cities. And then there's the geographic expansion into international places as well. So Europe, and like it doesn't exist in Australia yet, but I can imagine that being a popular thing there too. So I don't know. There's a lot going on here, and there's a lot of places to continue this runway for a long time. So I feel pretty good about the runway. Now on this page of the report, it actually is worth going through why the franchise model is significantly better than the traditional model that the industry normally operates in. So the traditional model, there's this fluctuating compensation, obstacles to expense control because there's just that distance between head office management and the ground. And with the franchise model, you've got more aligned incentives where the franchisees are essentially like small business owners in their own right. They need to drive their profitability of their business for their own individual selves. So they want to control expenses better. There's no reason for them to spend more money than they should because it hurts them individually being the owner. So these incentives are really important. And that's where the traditional models don't work, because it's this tightening of expenses, and that caring about the profit at the franchise level is really important. Now turning to some of the financial metrics. Firstly, I want to look at just revenue growth. And that has been growing at about 40% plus for the last couple of years, as you can see here in this little graph. Now, if we look at income from operations, as a percentage, so we're looking at the margins here. There was 31 million in revenue and about 16 million in income from operations. So that margin is a little bit over 50%, which is very strong. So we've got strong revenue growth rates. We've got strong margins as well. Then turning to return on invested capital, that's sitting somewhere between 20 and 30% pretty consistently. The structures are in place for this to continue. The question I asked myself was, are they using all of their cash? And recently, because they've been making some large acquisitions, they've been spending more than the cash that's coming in. Hence, they do have a small amount of debt that they have because they're in this growth mode. I think it's safe growth using the cash and a little debt to make the acquisitions. I like that. And with that strong return on invested capital, this is really good to see. I think it's good decision making. Then regarding that debt, it's actually sitting at 0.7 debt to EBITDA as a ratio. And that's really good for a serial acquirer. A lot of serial acquirers push 2 times, but this is under 1, and they've always been conservative with debt. So I'm very happy with how they manage that. Regarding free cash flow, it converts really highly. It's been growing at about 40% in line with revenue, so that's strong. Now, turning to shares outstanding, there has been a little bit of dilution through stock-based comp. I guess it's the only issue I've seen so far. It's about 1% per annum, roughly. It's low, but there is a bit of stock-based comp there. The dividend is around about 25% of a payout ratio, which I don't really like because of the strong return on invested capital. And that runway is really long. I don't know why they want to pay out 25% of their cash flow in dividends and take it out of the business. But I guess keeping it relatively small, 25% small enough. I wouldn't want much bigger than that. It shows that the business is less likely to be fraudulent. They're actually making real cash they have to hand out to shareholders. Therefore, we have a bit more comfort knowing that they're not lying to us. So they have to give us some cash. So I can see two sides to that dividend idea. Regarding incentives, Rick, the CEO, owns 43% of the company. Insiders own 60% in total. That's serious alignment. That's good. Now, if I was to summarize the growth opportunity of the business, I think we've got more geographic expansion through acquisitions. They've got plenty of cash to make acquisitions as well. And that command center payback is actually about to end. So these franchisees are about to get a lot more money and they're going to have the opportunity to expand as well. So more franchises coming on into the system, which is very positive from a head office point of view. And that's what we're investing in, is that head office. So the more I dig, the more I like this business. I want to do a competitive analysis looking at what the market looks like out there. And I'm going to talk about one more big risk that I found, and then we're going to do a valuation. So that's in the next video. That'll be the last one. So stay tuned for that. I hope you're enjoying this analysis. I will see you in the next video.